Welcome back. Here with us on Trading Hour. The market is as flat can be, less than what, 1 point down on the Nifty. That's how it's playing out. The Bank Nifty is also completely flattened out. At least there's no, bigger decline from the bulls' perspective. I think they'll take heart from that. But let's get that conversation going with Varun Lohchab, head of institutional research at HDFC Securities. Varun, good morning and thank you for joining in. The season has been all about the talk of downgrades and how estimates are getting pruned. I was looking at your note. I think you've also reduced estimates for FY23, I believe, by what, 1.3%? Your summation of what the season tells us, do we really have to worry about corporate growth and profitability?
I think in our case, overall downgrades wasn't a big number. If you see FY23, 1.3%, FY24 is largely flattish. I think there's a marginal upgrade 0.3, but part of the reason is we were, anyway conservative. We were cautious at the start of the year, this financial year, and our earning estimate for the full year was in single digits. And we were calling that out that street estimates will get downgraded. I think this year would be single digit, and then next year, as of now, it's 15% earning growth. While there are some downside risk, I am not overly worried on overall earning growth of Nifty. We don't see any big reason for earning downgrades per se, but at the same time, if you look at the breadth, I think this quarter what was slightly more negative than the headline earnings was the breadth that this time around only 40% of our coverage companies, which is 220 odd companies, beat estimates. This number was hovering around 50 to 60% range consistently over last 4 to 5 quarters. So which means that there was only a handful of companies which helped maintain the overall Nifty earnings in a certain band, but in a broader market, the pain was there. And we believe while this will, I think, sequentially improves slightly because from Q4, the benefit of lower commodity prices will come in more into the P&L. This quarter was saved entirely by BFSI. If we were to X BFSI out, then there was a decline in earnings. BFSI will take a bit of breather going forward. It will still be very healthy, but may not be able to save the day for rest of the sectors. But rest of the sectors we believe will marginally improve. So net, not overly worried on earnings, but there could be some marginal downgrades to FY24. As of now, the chances of downgrades are slightly more than upgrades, but it won't be a big material, 10-15% kind of downgrades. There might be 2-3% kind of downgrades. So it will be a slow grind kind of an year where valuations are anyway still a bit on the higher side despite the consolidation of last 1 year. So this year will again go in consolidation in our view. Earnings will probably chug along at that low teens kind of growth rate, and valuations will come down. So net your returns will be very muted at index level. That's our base case scenario.
Varun, you have been calling out that this year one shouldn't expect very high returns from the market, and this has been your consistent stance. But just want to take that point forward. FY24 earnings growth estimate is 15% from you. This compares with just 9.5% for FY23. What could be the extent of downgrades? Does this 15% number come down to 10%? Does it come down to 12%? Because even at the beginning of the year, if I had asked you about FY23 earnings projection, it would have been higher than 9.3% that it currently is. So this year through the course, we have seen downgrades.
Yeah, so but most of the downgrade this year, we were in single digit after Q1 itself, after the commodity shock which had come in due to the war. And ever since, we have not seen material downgrades. Next year, what can bring that 15% down to, I would say 10%, probably, if I look at the components, I think BFSI, we are already building in a sequential NIM contraction. So I really doubt BFSI will pull it down significantly, maybe 1-2% if credit growth really slips due to higher interest rates. So BFSI, I would say we are not so much at risk because we are anyway building in a decent sequential NIM contraction over the next 2 to 3 quarters, which actually may not come through given that if we still have rising rates. IT we are building in around 8-9% kind of a growth. I think there is a possibility of maybe a couple of percentage points shaving off out there. Barring that, the only scenario in which I think that earning downgrades will happen in the rest of the sector is if we see a spike in crude, back to 100, 110 levels, because then the commodity consuming sectors where there is a bit of earning upgrades or say earning growth being higher built in for FY24 may not come through. So I think that is something to watch out for. If commodities remain where they are, I think somewhere between 12 to 13% earning growth we should at least get, if not 15%, is what my view is.
Okay, 12 to 13%. Varun, we would have loved to chat some more, but unfortunately we're completely out of time, so we will continue